Hello, tax colleagues. Greetings to all of you. My name is Melissa from Halim Santoso and Associates. In this bijak session, I would like to continue to discuss the second issue in the OECD guidance on the transfer pricing implications for COVID-19 pandemic. If you like this video, please give a like, subscribe, and share our channel. Thank you in advance for support. So, today's agenda, we will be focusing on the losses and allocation of COVID-19 specific causes. And if you would like to learn more about the first chapter regarding the comparability analysis, please do help yourself by checking the link in our description box. So, shall we start? During the COVID-19 pandemic, many multinational groups have incurred losses due to a decrease in demand or an inability to obtain or supply products or services because of exceptional non-recurring operating costs. The guidance acknowledges that the allocation of losses between associated entities can give rise to disputes. Therefore, it requires consideration given the increase in the frequency and magnitude of losses in the current economic environment. There are three aspects that need to be discussed regarding losses and the allocation of COVID-19 specific causes. First, it is important to focus on the allocation of risks between the parties which affect profits or losses resulting from the arm's length transaction. And second, it will be necessary to consider the allocation of the exceptional non-recurring operating costs between the parties which came up due to the COVID-19. The exceptional non-recurring operating costs would be in the form of the expenditure on IT infrastructure system, resetting office space to implement physical distancing requirements, or health-related safety equipment. Lastly, associated parties may consider where they have the option to apply force majeure clauses, revoke or revise their intercompany agreements by considering the current economic environment. Next slide. How force majeure affect the allocation of losses from the COVID-19 pandemic? Force majeure can be used to suspend or release a company from its contractual obligations without liability in certain situations. However, this may result in losses for the company because the company may lose customers or suppliers, causing business operations to close and may involve restructuring costs. For example, a force majeure that occurred during the COVID-19 pandemic could be the prohibition of activities by the government by enforcing closure to production or retail facilities. In response to COVID-19, some taxpayers may seek to assert force majeure in situations where it's not contained within the relevant intercompany agreement. Some may seek to change an existing intercompany agreement to insert a force majeure clause. Moreover, some taxpayers may seek to assert that a renegotiation at arm's length would have similar economic outcomes. In those circumstances, what should tax authority do? The tax administration should carefully review the agreements and/or behavior of the companies concerned with respect to the transactions that are accurately described and the circumstances of the transactions that are economically relevant. If there is a renegotiation of the taxpayer and the parties related to the agreement, the tax authority needs to confirm whether the renegotiation is in accordance with the OECD transfer pricing guidance. Next slide. Now, we are going to discuss the issues arising from COVID-19 and the solutions provided by the OECD regarding the losses and allocation of COVID-19 specific causes. The first issue: can entities operating under limited risk arrangements incur losses? When performing transfer pricing analysis, the activities carried out by the entity can be categorized as limited risk, in which the company has a relatively lower level of function and risk. OECD states that simple or low-risk functions in particular are not expected to generate losses for a long period of time. This holds the possibility that simple or low-risk functions may incur losses in a short run. For example, where there is a significant decline in demand due to COVID-19, A limited risk distributor with limited inventory ownership, such as through the use of flash title, may still assume some market risk due to lower demand and may earn a loss associated of this risk even at arm's length. Conversely, a limited risk distributor that does not assume credit risk from the defaulting customers should not bear losses resulting from the write-off of bad debt. So, what can the tax authority do when facing this kind of issue? When considering the risks assumed by a controlled transaction party, tax administration should consider any changes in the risks assumed by a party before and after the COVID-19 pandemic. For example, before the outbreak of COVID-19, a taxpayer argues that a limited risk distributor did not assume any marketplace risk, therefore was only entitled to a low return. But after the outbreak, the same distributor assumes some marketplace risk due to changes in risk management functions, therefore should be allocated losses. In this case, tax authorities should consider to re-examine if the assumed risk is completely genuine or as a result of business restructuring. Modification of intercompany agreements. This issue relates to the application of force majeure clauses and the option to revoke or revise intercompany agreements. In response to the COVID-19 pandemic, independent parties could seek to renegotiate certain terms in their existing agreements. Associated parties may also consider revising their intercompany agreements too. Given the current economic environment, it is possible that independent parties may not strictly hold another party to their contractual obligations, particularly if it is in the interest of both parties to negotiate the contract or to amend certain aspects of their behavior. For example, unrelated enterprises may opt to negotiate a contract to support the financial survival of any of the transactional counterparties given the potential costs or business disruptions of enforcing their contractual obligations, or in view of anticipated increased future business with the counterparty. This behavior should be considered when determining whether or not associated parties would agree to revise their intercompany agreements in response to COVID-19. So, what can the tax authority do? Tax administration should review the agreements conducted by the associated enterprises, together with observations of the behavior of the independent parties, in order to ensure whether any such renegotiation should be respected under the OECD transfer pricing guidance. The control transaction will determine whether a revision of the intercompany agreements is consistent with the operating behavior of the independent parties under comparable circumstances. To determine a negotiation of an arrangement requires careful consideration of their options and the long-run effects on the profit potential of the parties. For example, an entity may agree to restructure a transaction if the alternative option is losing a key customer or supplier, where it considers that the restructuring will maximize its profits in the long run. Therefore, tax authorities should also consider whether there's an impact resulting from the renegotiation may require restitution of the harmed party. The next issue is regarding to the allocation of operational or exceptional costs. Due to the COVID-19 pandemic, many enterprises have incurred exceptional, non-recurring operating costs, which include expenditure on personal protective equipment, resetting workspaces to enable physical distancing, IT infrastructure expenses, and implementing teleworking arrangements. In order to determine which associated enterprise should bear the costs, it will be necessary to observe the control transaction in order to show who has the responsibility for performing activities related to the relevant costs and who assumes risk related to these activities. There's also a treatment of exceptional non-recurring costs according to OECD, which can be determined by the risk analysis assumed by the parties towards their intercompany transaction. Second one, an understanding of how independent enterprises may reflect such costs in arm's length prices. And third, how such costs may impact prices in transactions between the associated parties. It should be noted that certain operating costs may not be viewed as exceptional or non-recurring in circumstances where the costs relate to long-term or permanent changes in the manner in which business operates. Next slide. How should exceptional costs be taken into account in a comparability analysis? First, exceptional costs should generally be excluded from the net profit indicator. The exclusion of exceptional costs must be done consistently at the level of the tested party and the comparables to ensure a reliable outcome, noting that the availability of this information may be limited. Second, when determining a cost basis, it will be important to consider whether the basis should include or exclude exceptional costs that are related to the controlled transactions. Including exceptional costs in the cost basis would transfer these costs to the counterparty, whereas excluding them would have them allocated to the tested party. Therefore, in determining which approach is the most appropriate, it will be important to consider which party in the controlled transactions would have borne these additional costs. Third, accounting adjustments may be required to improve comparability. Adjustments can be used to eliminate accounting inconsistency between the controlled and uncontrolled transactions. There can be differences in whether the COVID-19 related costs are above or below the gross profit line. For instance, the purchase of personal protective equipment is recognized as an operating cost by the tested party and as a cost of goods sold by a comparable. In this case, it may bring out significant impact when calculating the profit level indicator based on gross profit and may require comparability adjustments. So as for the conclusion, this guide gives priority to the analysis of a specific taxpayer along with its functional profile and the risks assumed before and during the pandemic while allowing modifications to pre-existing agreements with related parties, and also ensuring that those agreements are made in line with the arm's length principle. This guidance also allows the allocation of losses and exceptional costs arising from COVID-19 and also refers to the provisions of force majeure and observations of the behavior of unrelated parties. This is the end of the discussion of losses and allocation of COVID-19 specific costs. Thank you for your time and see you in the next video for the next issue of Transfer Pricing Guidance on Government Assistance Programs.